Hope you had a good day. My apologies for getting a bit late. Sorry, I got stuck in the traffic jam. We are going to continue from where we left in the yesterday's class. So up till now, what have we done? If you could just recall from the first day slide, so you would actually realize this thing that we did actually talk about the overall audit process. And in the overall audit process, we talked about the fact that whenever we talk about the audit, so the audit has got various steps and the various stages. And those various stages of the audit actually include the tendering stage, and then there was the engagement letter signing stage, then there is a planning stage, performance stage, and finalization stage, and afterwards there is a reporting stage. So what have we discussed up till now? We have actually gone through the overall audit process from start to end. We have actually talked about that how the audit goes about, how the planning is done. And in addition to the planning, what we have actually talked about is we have also talked about that in addition to the planning, we need to go for the performance stage of the audit also. And then in addition to performance stage, we talked about how the finalization or the review of the audit goes on. And in addition to it, yesterday we discussed about the audit reporting area. So we discussed that what is audit reporting all about, how is the audit report constructed, what are the components of the audit report, how are the audit reports modified, what is the key audit matter area which is newly being introduced. In addition to this, we also discussed about the other areas of the audit, which is the either 720, the other information area. We talked about emphasis of matter and the other matter. So we did go through it. And in addition to this, we also performed few of the questions. So what is going to be our agenda for today? Our agenda for today is going to be, we are going to Okay, so our agenda for today is actually going to be, we are going to go through the going concern area. We're going to discuss going concern. We're going to discuss ISA 570. And in addition to ISA 570, we are actually going to start doing the assurance area. And in assurance area, we are going to discuss ISRE, we are going to discuss ISRS, and we are going to discuss ISA. So we would probably go for some question on the due diligence engagement. And in addition to the due diligence, we are also going to go for some environmental and social reports. And in addition to this, we would actually discuss the prospective financial information. So that is also going to happen. So this is what we are going to discuss. So our agenda for today is going to revolve around it. We'll try doing around 3 to 4 questions pertaining to it, so that in tomorrow's session, which is on 27th of October, what we can do is that we could then go about discussing the section A of the syllabus, and section A of the syllabus is going to be this quality, ethics, professional issues, and laws and regulations. So anyways, what we are going to do is that we are going to have a short break. I think a lot of you might actually have been waiting for namaz also. So we'll have a short break, a 10 minutes break for the namaz. We have 10 minutes break for namaz, and we are going to continue after that. Okay, for those of you who had been requesting that you want this access to the Word file that I'm actually using for writing down the answer, the Word file is being attached now. It's gonna get attached in a while onto this screen. So you could actually go through this Word file and you can have an idea that what is actually going on. So now we're going to continue from where we left yesterday, and what I'm going to do is that I'm going to start off with the ISA 570 going concern. So let's talk about this ISA 570 going concern, that what exactly is ISA 570 going concern all about. So now if I talk about this ISA 570 going concern, so let's discuss that what exactly is this ISA 570 going concern. You would actually realize one thing, that the financial statements that an entity prepare, they are prepared on a going concern basis. Now, what do we mean by financial statements being prepared on a going concern basis? The financial statements being prepared on a going concern basis, it actually means that the management, while preparing the financial statements, management believes that the entity will continue for the foreseeable future. And what is considered to be a foreseeable future? So foreseeable future is generally considered to be a 1 year. Foreseeable future is generally considered to be 1 year. So whenever we talk about the financial statements being prepared on a going concern basis, so we need to understand this thing, that is the financial statements are prepared on a going concern basis. That means the management is estimating that the entity will continue for the foreseeable future, and foreseeable future is a 1 year period. Now, if I move further, if I discuss further, so what happens is that if an entity is not a going concern, then the next step is, if the entity is not a going concern, then the next step is actually, if the entity is not a going concern, then the next step is that the financial statements are prepared on a breakup basis. So what do we mean by breakup basis? That the values assigned to the asset are the values that at which they would be sold, which is their NRVs, and the values assigned to the liabilities are the values which are actually their settlable values, because at times the liabilities might not be settled. At times the liabilities might not actually be settled at a value at which they are stated in the balance sheet. If you go for early termination of the loan provider may actually demand an additional and an extra penalty. So that might actually arise also. So if I talk about this, so I would say that if the entity does not have a going concern basis, then the financials would be prepared on a breakup basis. And breakup basis means that the assets are recorded at the NRV and the liabilities are recorded at the settlable value. Now let's move forward. So basically what happens is, this is the basic that we have discussed. Now we are going to discuss further. The auditor is actually responsible to assess validity of the going concern, assumption. And if I say that, what do you mean by this? So the auditor is responsible to assess if the going concern assumption obtained or made by the management, if it's a valid assumption or it's not a valid assumption. Now I will discuss further. So what we need to do is that right now we need to consider there are several factors or several indicators that entity is not a going concern. There are several factors or several indicators that the entity is not a going concern. And what are those? That is liquidity issues, loss of key personnels. At the same time, so basically one of them is the liquidity issues, the second one of them is the loss of the key personnels, and then in addition to it, if we talk about it, So there is actually cancellation or expiry of license, loss of key customer. So apparently there are a lot of issues that actually arise with respect to an entity, and that could cause a doubt on the entity's ability to continue as a going concern. So that could be the case. So basically, as an auditor, what you need to do is that you need to assess if the entity is a going concern or not, and then your audit report, your audit opinion is then going to take a course of action which you perform while assessing it. So now, what are going to be the implications on the audit report? What are going to be the implications on the audit report if the going concern is not valid, or if the going concern is valid, etc., etc. So assume that, number one, that entity is a going concern. Assume that entity is a going concern. So what would happen is financial statements will be prepared on a going concern basis, and there's going to be no modification. But if the entity is not a going concern, if the entity is not a going concern, then what could be the scenario? The number one scenario is financial statements are prepared on a breakup basis. So if the financial statements are prepared on a breakup basis, then what would happen is there's going to be an unmodified opinion, because the entity has done the correct thing of preparing financial statement on a breakup basis. There would be an unmodified opinion, plus there is going to be an EOM para. There is going to be an EOM para. So the financial statements are prepared. So see, if the entity is not a going concern, then what would happen is that the financial statements are going to be prepared on a breakup basis. And the financial statements are going to be prepared on a breakup basis, and there is the auditor will issue an unmodified opinion, and he would highlight an EOM para referring to the going concern, referring to the section where it is mentioned that entity is not a going concern and that financial statements are prepared on a breakup basis. So that is one thing, that the financial statements are prepared on a going concern on a breakup basis. Now what could be the second situation? The second situation is financial statements are prepared on a going concern basis. So probably what would happen is, I would talk about what the AISA states, and then I would talk about the practicalities also. So in accordance with AISA, that means that the financial statements are prepared on a going concern basis means the effect is pervasive. Why the effect is pervasive? Because there are two problems. One of them is the effect is pervasive because there are two problems. And what are those problems? Number one of them is the basic assumption, the most important assumption. The basic assumption or the most important assumption is not actually valid assumption. Because you are not a going concern, but still you are preparing financials on a going concern basis, so there is a problem with the basic underlying assumption. The second issue that actually arises is that multiple elements of financial statements are misstated. Because if the entity is not a going concern, then financials should have been prepared on a breakup basis. If the financials were to be prepared on a breakup basis, that means everything would have been different. So basically what happens is we give an adverse opinion. Now there is a third case with respect to the going concern, so we are going to discuss that also. We have discussed that entity is a going concern. We have discussed that entity is not a going concern. And the third case is entity is a going concern, but there is a material uncertainty to the entity's ability to continue as a going concern. So what would happen is there could be certain situations in this scenario that the entity is going concern, but there is a material uncertainty to the entity's ability to continue the going concern. Now what do we mean by this? This means that there are several things which could lead to entity not being a going concern. Generally the entity is going concern, but there could be some aspects, there could be some factors which could result in entity not being a going concern. Now what could be that thing? So you need to actually understand a bit that at times what happens is there is a court case pending against the organization. If the entity will lose in that court case, then the result would be that the company may not become a going concern because the liabilities would exceed the net assets that the entity has. Or there might be a possibility that a dispute has arisen with the major supplier, and if the supplier halts the supply, you don't have an alternate supplier. So uncertainty with respect to going concern could arise. So now whenever there is an uncertainty with respect to going concern arises, the accounting requirements are that you have to give an appropriate disclosure. The accounting requirement is you need to give an appropriate disclosure. Now, if we need to give an appropriate disclosure, this is what the accounting requirement is. So what an entity may give appropriate, may not give any disclosure. The entity may not give any disclosure, or the entity may give inadequate disclosure, or the entity may give proper disclosure. Now what we need to do is that we need to discuss the accounting, the audit implications in these various cases. So we need to discuss the audit implication in these various cases, that what would be the audit implications. So I'm going to discuss the audit implication in these various cases. So number one of them is actually, not give any disclosure. So what would happen is the auditor might give the adverse or disclaimer of opinion. The auditor might give a disclaimer of opinion or the adverse opinion. The second thing is that the entity may give inadequate disclosure. So if there is an inadequate disclosure, then you would actually give a qualified or adverse opinion depending upon the pervasiveness. So you're going to give a qualified or a adverse opinion depending upon the pervasiveness. And the third one of them is the entity may give a proper disclosure. So proper disclosure is then there would actually be a material uncertainty section in the audit report. Okay. So now, I'm going to repeat it again. So when we talk about this going concern, the number one thing is that the entity is a going concern. The financial statement will be prepared on a breakup basis and everything would be okay. But there could actually be the case where the entity is not a going concern. There could be a case where the entity is not a going concern. So if the entity is not a going concern, then what is going to happen? The financial statement should be prepared on a breakup basis. If the entity has prepared, then an unmodified with an EOM paragraph. But if the financials are prepared on a going concern basis, then the effective pervasive, and this would result in an adverse opinion. Furthermore, if there is a material uncertainty to going concern, then accounting would actually be that you might not give any disclosure, you may give adequate or inadequate disclosure, or you may give a proper disclosure. So these could be the case. Now, what we are going to do now is we're going to move on to December 2015. December 2015, question number 2. So December 2015, question number 2. This is a question on Kandinsky company. This is a question on Kandinsky company. So you try to attempt this question. You've got around 9 plus 6, 15 minutes, 15 marks. So 15 marks, you try to actually take around 6 minutes, 7 minutes. So you take 7 minutes till 6:55 p.m. to attempt this question. Okay. So now let's start discussing this question. If we talk about this question, the question says that Malwick and Co. I'm going to answer the questions that you have in a while. Let me first actually get through this question. Now, number one is basically Malwick and Co. is a firm of chartered accountants offering chartered certified accountants offering audit and assurance services to a large portfolio of clients. You are a manager in the audit department responsible for the audit of two clients. Now it says Sky and the Rothko University. So you are responsible for the audit of Sky and Rothko University. Both have a financial year end of so and so, so and so. Now the requirements of this questions are, in respect of the audit of Sky, identify and explain the matters which may cast significant doubt on the company's ability to continue as a going concern. So you need to actually, in respect of the audit of Sky company, you need to identify and you need to explain the matters which may cast significant doubt on the entity's ability to continue as a going concern. That's something. Secondly, so that means you need to identify the matter and you need to explain that why. And it says recommend the audit procedures to be performed in relation to the going concern matters identified. So you need to perform the audit procedures also in relation to the going concern matters identified. So we're gonna discuss the audit procedures also with respect to the going concern matters identified. Now, if I talk about it, it says Sky is a manufacturer of luxury food items including chocolate and other confectionery, which are often sold as gift items individually or in hampers containing a selection of expensive items from a range of products. It says due to an economic recession of products, sales of the products have fallen sharply this year and measures have been implemented to support the company's cash flow. You're aware that the company only has $150,000 in cash at the year end. Now you see, if we talk about the company's cash position, so it's only 150,000. Over there, the total assets are basically 10,400,000. So if you look at it, you would actually see that the company is almost running out of cash. So the company's cash position is not good. So if we talk about this Sky company, number one is cash balance is quite low. That's number one. Number two, the cash balance is quite low, and the number two thing is that the extracts from the draft financial statements and other relevant information are given below. You've been given the extracts from the draft financial statements and other relevant information. You've been given July 2015, you are given July 2014. So if we talk about it, we're going to say that July 2014, July 2015. You would see there is a decline in the revenue. So what you need to do is that you need to talk about the revenue change. At the same time, you need to talk about the operating expenses change. And at the same time, you need to talk about the finance charge. So one of the point is basically the cash balance is quite low. So one of the point is the cash balance is quite low. You need to discuss the revenue, that what is the change in the revenue. Somebody could please calculate the change in the revenue. Revenue is declined by 38%. So the revenue has declined by 38%. And what about the operating expenses? What about the operating expenses? They have declined by 25%. And what about the finance cost? It has increased by 4%. Okay, now let's talk about few things. Number one, our requirement is identify and explain the identify and explain the matters that may cast significant doubt on the entity's ability to continue the going concern. So you talked about it that the business has a low cash balance. Then there is this declining sales. Then there is this operating expenses. Then there is finance costs. The other point is the entity has converted from profit to loss. The entity has changed from profit to loss. Furthermore, the total assets are 10,400. Last year it was 13,500. So the assets are declining, but is it a matter which make us doubt on going concern? So we need to see assets are declining. If we talk about the long-term loans, which is the bank loan, it says the bank loan was extended in March 2015. So we've obtained a loan of $500,000 by drawing on the borrowing facilities offered by the bank. Loan carries a fixed rate of interest and is secured on the company's property, including the head office and the manufacturing site. The first prepayment of the loan capital is due on 30th June 2016, when $350,000 is due to be paid. If we talk about the scenario, if we talk about the situation, so we would come across this thing, that the point number D is that if you would come across this thing, so it is actually going to be the loan is secured on properties, value of assets have gone down, so might be that value of properties have also reduced and the bank might become a bit concerned about recovery of the amount it has lended. Number 2 is basically short-term liabilities, the trade payables. The Camden Sky renegotiated its terms of trade with its main supplier of cocoa beans and extended payment terms from 50 days to 80 days in order to improve working capital. So we know that the working capital is financed by negotiation with supplier. Working capital is financed by negotiation with supplier. Number E and number F is basically undrawn borrowing facility. States the borrowing facility are due to be reviewed by the bank in April 2016 and contains covenant including that interest cover is maintained at 2 and the ratio of bank loan to operating profit does not exceed 4:1. So there are covenants by the bank and you need to calculate the covenants for both 2014 and 2015. So you need to calculate the covenants for both 2015 and 2014. So if we talk about the covenants for both 2014 and 2015, so let's just talk about it. You're going to see that there are two covenants. One of them is interest cover. The other one of them is basically bank loan to operating profit. Can you please calculate the interest cover and the bank loan to operating profit ratio for both the years? Can somebody please calculate it? If you have forgotten the formula for the interest cover and for the for the interest cover. So the formula for interest cover is PBIT upon the interest expense. Can somebody please another number, because there are two different numbers that the students have provided. Okay. It's what, 0.65 and it's 2.3. So it's 0.65 here and it's 2.3 in the next year. In fact, it was 2.3 in the last year. And what about that other bank loan to operating profit? Can somebody please calculate the bank loan to operating profit? Junaid Bajwa, you need to adjust. Yes, say okay, you got it. 10.3. And what about last year? 2.6. Okay. Thank you. Now let's see. So it says the borrowing facilities are due to be reviewed by the bank in April 2016 and contain covenants including that interest cover is maintained at 2. Now, so if it says that the interest cover is maintained at 2 and the ratio of bank loan to operating profit does not exceed 4:1. So if you see, both the covenants are breached. So probably the bank might withdraw the borrowing facilities that it has extended. Furthermore, note number 4, the contingent liability relates to a letter of support which Kandinsky has provided to its main supplier of cane sugar, which is facing difficult trading conditions. So if I talk about it, the contingent liability relates to a letter of support which Kandinsky has provided to its supplier of cane sugar. Now, if I actually talk about it, so what I'm actually going to do is that, see, you have got a main supplier and sugar is one of the key components for your chocolates. If the main supplier is in need of money, and if you're not going to support it right now, saying that we don't have the we ourselves are running out of cash, so that supplier might actually get offended and he might not cooperate with you the way he cooperates right now. So that could also be a problem. So that could also be a problem. Now, if I actually summarize the problems, the issues that have arisen, number one of them is cash balance is low. The second thing is the cash balance is low. At the same time, your industry is in recession, and products that we sell are not going to be in demand till the time recession period is over. Sales have declined, but operating expenses have not declined proportionately. The sales have declined, but the operating expenses have not declined proportionately. This goes to show there must be fixed costs. There must be fixed costs. Now, so in times of declining sales, fixed costs becomes a problem. The business has gone to profit to loss. The assets are declining. So I did talk about that the loan is secured. Working capital is financed by negotiation with supplier through extended credit period. So this is what it is. So the covenants have been breached and there is a risk that the bank might not actually extend the borrowing facility. So where are you going to stand? So apparently the business is raising the expected cash flow position of the business. The expected cash flow position of the business is going to be that currently the current cash is 150,000. Then expected loss for next year. Current cash is 150,000. The expected loss for next year is going to be 180. If I assume that the conditions remain the same, 180 is going to be the loss. Furthermore, there is going to be a contingent liability of 120, and then there is this repayment of the loan, which is going to be 350. So if we evaluate, the expected cash flow would actually stand at this 300, 350, 650, 150. So the cash flow would actually stand at a position of net cash position is going to be, you would be short of cash by 500. So this 500 could only be funded by the undrawn borrowing facilities. So what happens is, if the bank does not withdraw borrowing facilities, then entity can survive, or else it will go bankrupt. Okay, so if the bank, this company goes bankrupt, the company would go bankrupt if the bank is not going to renew the borrowing facilities. So this is something that you need to actually see. Let's move forward. So we have actually gone through the area that what are the areas which you think would cause the entity to not be a going concern. Faria, just wait for 5 minutes. We'll give the break. Just wait for 5 minutes. Now let's move forward on to the next requirement of this question, and the next requirement of this question is that recommend the audit procedures to be performed in relation to going concern matters identified. Now, if I say that the audit procedures to be performed in relation to going concern matters identified, now one point that I would want you people to understand that how do we perform the audit procedures? For you to perform the audit procedures, you need to understand one thing, that the audit procedures, for you to perform the audit procedure, you need to understand one thing, that the audit procedures are the procedures to check if something has gone wrong. Now, here we have to perform procedures on going concern. So now what is going to be our question? Our question is going to be, is the entity a going concern? Our question is entity a going concern? That's what our question is. So now, what would make this entity a going concern? Number one, the various things. Recession, end of recession. That would be one of the factors. What is going to ensure that the company is a going concern? The end of recession. Reduction of loss. Furthermore, continuous extension of credit by cocoa supplier. Management of funds for cane sugar supplier. Bank facilities are not withdrawn. So basically you need to perform the procedure to check is the recession ending. So the economic surveys or the economic surveys that could actually guide you if it is going to end or if it is not going to end. Then the second one of them is reduction of loss. So what plans does management has? Plans for reducing fixed costs. Now in addition to this, correspondence with cocoa supplier. Correspondence with the cocoa supplier. In addition to this, correspondence with cane sugar supplier. Furthermore, you need to correspondence with bank and assess likelihood of borrowing facilities remaining. So these are the various procedures that you're gonna perform in order to assess the likelihood of the entity being a going concern. I hope that this actually clarifies the whole thing. So let's keep it till here. Let's just take a namaz or a short break of 10 minutes. So we'll have a 10 minutes break till this 7:32 p.m. and we'll resume then and we'll go on to the next area of assurance. Okay, now welcome back. We did go through the going concern area. Now what we are going to do is that we are now going to move forward and we are going to discuss further. Okay, now so up till now this is what we have done. Now we are going to move on to the section E of the syllabus, and the section E of the syllabus is assurance and other engagements. Now let's just talk about the type of engagements that we actually have. So what I'm going to do is that I'm going to discuss the type of engagements. So the various type of engagements that we have is, number one is assurance engagement. And when it comes to assurance engagement, so we have got assurance engagement pertaining to historical financial statements, and we have got assurance engagements with respect to the other than historical financial statements. And when we talk about the historical financial statements, so we have got there is a audit and there is a review. And when we talk about other than historical financial statements, the other than historical financial statements are just one sort of engagements. And then there are these non-assurance engagement. So one of them is there are these non-assurance engagement. So when we talk about these assurance engagement, there are these non-assurance engagements. So let's just talk about the engagements. If we talk about the engagements, we have got assurance and we have got non-assurance engagement. So if I talk about the assurance engagements could actually be pertaining to historical financial statement. They could actually be pertaining to the other than historical financial statements. So if I talk about the assurance engagement, they could be pertaining to historical financials. They could be pertaining to other than historical financial statements. Now, what exactly are these other than historical and historical financial statements? Let's just talk about the difference between the audit and the review. So basically the audits are covered by AISA. The review engagements are covered by ISRE, and other than historical financial statements are covered by ISAE, and non-assurance engagements are covered by ISRS. So in addition to this AISA, the IAASB have got. So I'm going to talk about it that in addition to the engagements, in addition to the ISA, the IASB pronouncements include the ISRE, the ISIE, and the ISRS. So these are also the various pronouncements that are there. So now let's just talk about it. Let's just discuss, okay, what exactly are these. Number one of them is, if we talk about the review engagement, so what exactly is the review engagement? So I'm going to talk about this ISRE, which is the International Standards on the Review Engagements. So I'm going to talk about what exactly are the review engagements. Generally speaking, what happens is that at times what happens is that the audit is not mandatory. Audit is not mandatory in few jurisdictions. So if the audit is not mandatory in the various jurisdictions, then the owners or the shareholders want a lesser amount of assurance. So let me talk about it, that at times what happens is that the audit is not mandatory in few jurisdictions. So if the audit is not mandatory in few jurisdictions, the owners or the shareholders, they want the lesser amount of assurance. Now if they want lesser amount of assurance, then what is actually going to happen is that so if the owners or the shareholders want lesser amount of assurance, what they are going to do is that they're not going to go for audit. They're not go for audit. Why they will not go for audit? Because the audit is actually an expensive task. Why is the audit an expensive task? Because audit is a high level assurance activity. Audit is a high level assurance activity. So what happens is that the organizations, they go for a lower level assurance, and the lower level assurance, the alternate is actually to go for the review engagements. Now, how is this review engagement different to an audit engagement? How is this review engagement different to an audit engagement? So let's just actually talk about the review engagement, that how is it different to the audit engagements. So this is review and this is audit. So review is limited assurance engagement. Audit is reasonable assurance engagement. In addition to this, the other difference between the audit and the review is that the review engagement requires limited procedures. And what are those limited procedures? That only include the inquiry and analytical procedure, whereas audit would include all the procedures. The audit would include all the procedures. You would just not be confined to one of the procedures. It has to include all the procedures. And the third one of them is actually the review would include negative form of opinion, whereas the audit would include a positive form of opinion. Now you would have a question that what exactly is the difference between this positive and the negative form of opinion. So let's just talk about it. The negative and the positive form of opinion in the audit, when we talk about audit, so we say that financial statements give a true and fair view. Financial statements give a true and fair view. Whenever we talk about the audit, we say that financial statements give a true and fair view. And when we talk about the negative form of opinion, so negative form of opinion, we say that nothing has come to our attention that causes us to believe that financial statements do not give a true and fair view. So if I talk about this positive and the negative form of opinion, so what exactly is the difference between these two, the positive and the negative form of opinion? The positive and the negative form of opinion, the difference is that when we talk about the positive form of opinion, we actually say that financial statements give a true and fair view. And when we talk about the negative form of opinion, we say that nothing has come to our attention that causes us to believe that financial statements do not give a true and fair view. So you see the difference. One is the case where you're talking with surety and authority. The other is the case where you are actually not talking with authority. So these are actually the case. So now, so basically when we talk about the difference between audit and review, so this is where the difference lies, that the audit is a complete engagement where the reasonable assurance is being given and the auditor talks with authority. He says the positive form of opinion. But when it comes to review, it's a limited assurance engagement where the limited procedures are performed and the auditor talks with a negative form of opinion. So that's where the difference between audit and review lies. So why would a company go for a review? The review would actually be when the company does not need high level of assurance. The review would actually be when the company does not need high level of assurance, and at the same time the company does not need high level of assurance, and at the same time what happens is that the company does not need high level of assurance, In addition to this, the company does not want to spend the money, so the company is contented with reviewing it. The second one of them is other than historical financial statements. So if I talk about other than historical financial statement, I would give few examples. One of them is the KPI report. The other one of them is basically the environmental and social report. One of them is the KPI report, the other one of them is the environmental and the social report. And the third one of them is basically the prospective financial statements. The third one of them is other than historical financial statements. So basically, this KPI report, environmental and social report, prospective financial statements, let's just talk about them, that what exactly are they. Now see, KPI, which is the key performance indicator, a lot of companies actually need to issue or publish their KPIs. They need to submit to various authorities the key performance indicators. So the authority at times might require the report to actually be audited, or the report should accompany a reasonable assurance report by an auditor. So that might also be the case. The second one of them is environmental and social. A lot of companies actually publish their CSR report. The CSR report also needs to be accompanied by this report from the auditor. The prospective financial statement, where you talk about the future financial statements. When you talk about the future financial statements, so what would actually happen is that these future financial statements would actually be an issue. Now, why would these future financial statements would actually be an issue? The reason behind that is the future financial statement have got problem. The cash flow forecast may not be appropriate. The cash flow forecast may not be correct. So there are issues. So at times you need the auditor to actually accompany a report or give a report pertaining to it. So basically what happens is there are various pronouncements. The ISA for the audit, ISRE for the review, ISAE for the assurance engagement for other than historical financial statements. And lastly, there are non-assurance engagement on which ISRS applies. What are the non-assurance engagement? The non-assurance engagement actually includes, number one of them is basically the compilation engagements. Now what are these compilation engagements? Compilation engagements are generally when you actually undertake a task of compiling the information. Compilation of the financial, at times the companies, they don't have a proper accountant, so they would want an audit firm to come over and compile the financials from the trial balance. So that could actually be the case. In addition to this, if I actually talk about it, you might have agreed upon procedures. What are agreed upon procedures? At times the client wants you to come over and perform certain procedures, certain tasks, and they prescribe that what are the tasks that you need to perform. So you actually go ahead and you perform those tasks. So that's called an agreed upon procedure. So this is the overview. This is the basic concept of what the things are. What we are now going to do is that we are now going to move forward and we are going to discuss further. So what I would suggest is, right now there is this December 2015 question number 2 part B that you should try to attempt, and then we'll discuss. Okay. Now let's talk about this question, which is the Rothko University. Now, what exactly is the requirement to this question? The requirement to this question is you need to discuss the relevance and measurability of the reported performance information. You need to discuss the relevance and measurability of the reported performance information. Number two, you need to recommend the examination procedures to be used in auditing the performance information. Now, one thing that you need to understand is that when we talk about the relevance of information, what exactly do we mean by relevance of information? The relevance of information means that for a given entity, why is it a relevant KPI? Number two, measurability. At times what happens is there are a lot of non-financial KPIs and it is quite judgmental to measure them. It is quite judgmental to measure them. So what happens is at times there are non-financial KPIs and it is quite judgmental to measure them. So basically now what we are going to do is that we are going to discuss that what is the relevance and measurability. So it says that Rothko is a public sector university, a small university with approximately 2,000 students, which was established 10 years ago. So it has got 2,000 students, was established 10 years ago, and it specializes in vocational study programs leading to award of degrees in business, accountancy, finance, law, and marketing. It says highest performing students achieve a distinction on completing their degree program, indicating excellence in the knowledge and understanding of the subject. Students pay a tuition fee of $10,000 per year. Students pay a tuition fee of $10,000 a year, and the degree program is typically 3 years long. So it says that the degree program is typically 3 years long. Now, what happens is you've got this Rothko University, a public sector entity, a small university with approximately so and so, so and so. Now, the audit work in respect of the year ended 31st July is almost complete, but the audit senior has not yet completed the audit work in respect of performance information, which is being published with the annual financials for the first time this year. It's a requirement in the jurisdiction in which Rothko is located that the performance information is audited as part of the external audit. Now see, if I talk about this performance area, so what they have done is they have measured the performance of the university, and what are the items that they're using. Number one is graduation rate. Number two is academic performance. Number three is employability, and number four is course satisfaction. So what I'm going to do is that I'm going to discuss that why are these relevant. So what are they doing? They're actually saying that we are evaluating the performance. Basically what happens is they need to publish with the annual financial statement some of the KPIs, and that are pertaining to the performance area, the graduation rate. See, anybody who goes to a qualification goes for a graduation, goes for completing their degree, goes for completion of their degree, and goes for having the degree in hand. So if the degree is quite difficult, that only a very minute number of people are able to do it, so that means that that degree might not be worth doing. So you need to see that graduation rate, how many people graduate, what proportion of the people graduate. A lot of ACCA students, you people are now in the F5, in the P7, so you are almost on the verge of completion of your ACCA, but there is a huge dropout of ACCA students also. In fact, in every professional qualifications, you would come across that the students are unable to graduate. Inshallah, let's hope that you all are going to graduate soon. But it's a fact which cannot be denied. So the graduation rate is an important thing. The second thing is the academic performance. Now when we talk about the academic performance, so the academic performance is actually that how are the students performing. So it's also important that how good are the students are, or how is their performance. So that's also a very important aspect. The next thing is the employability. Now if you go to a university, and once you are done with your graduation, after the graduation you are actually being told you actually have to run here and there for the jobs. You are not being offered a job by anybody. That means that that university's degree is not really worth it. So if that university's degree is not really worth it, then that's a problem. So yes, employability is also relevant because that's what people look for the university. The course satisfaction, again, the course satisfaction is actually about that are the people comfortable with the way the course has been delivered. I mean, are the students actually comfortable with the way the courses are being delivered? So that's also important. So the questions requirement was discuss the relevance, so that you have to talk about that why are these things relevant, because we are evaluating a university's performance. For a university, people want to pass, people want to actually perform well, people want to be employable. At the same time, people should be happy with the way the course is being delivered. It's not just about delivering it, it's actually about delivering it to the satisfaction of the people who are consuming it. The second thing is its relevance. The second one of them is measurability. Now, are these measurable? The answer is yes, they are very much measurable. The graduation rate is something which is usually measurable. Academic performance is also a tangible item which can be seen, which can actually be quantified easily. The employability is a question mark unless and until, as long as you have got a good alumni detail, and the course satisfaction is something that's qualitative. So all of them are actually measurable. But then again, there are few things where the ready facts are available, few things which are actually subject to judgment. It says recommend the examination procedures to be used in auditing the performance information. Now, if I say the examination procedures to be used in auditing the performance information, so what you need to do is that you need to understand one thing. That the procedure, no matter whatever you are actually going for, the procedure would always involve you asking a question, what could go wrong. The procedure would always involve you asking a question, what could go wrong. So basically, you need to think what could go wrong. Now, if I talk about it, it says percentage of students who complete their degree program is 85%. So for the graduation rate, I could perform a procedure, and that is actually that we could say for the graduation rate, we could say that trace the students recruited 3 years ago with the students recently graduated to calculate the graduation rate. That's number one. Number two is academic performance. The academic performance is basically percentage of a students achieving a distinction. They say that the distinction is actually when you perform very well. The distinction is actually when you perform, the highest performing student achieve a distinction on completing their degree programs. So indicating excellence and knowledge. So what happens is that you need to inspect the criteria. You need to inspect the criteria for academic performance. You need to inspect the criteria for academic performance for this distinction. and then you need to actually test a sample against criteria to confirm that they meet. Test the sample against the criteria to confirm that they meet. So you need to inspect the criteria for distinction. You need to test the sample against the criteria to confirm that they meet this 20% ratio. Furthermore, there is this employability. And when we talk about the employability, it says percentage of students who on graduation obtain graduate level employment. So you could randomly check with students who are on job about the time it took them to obtain employment after graduation. Then the course satisfaction. You could have the procedure that for the course satisfaction, what can we do? We could actually have a procedure where we could say that if you want to go for course satisfaction, then it says percentage of students who rate their university experience. Have few questionnaires filled by the student to evaluate the course satisfaction level. So this is what you do, this is how you do. So the general thing is that you need to understand the basic idea, and the basic idea is that when you talk about the basic idea is that you need to understand that it's all about what you need to understand it. It's actually all about thinking what could go wrong and then checking if something has gone wrong or not. So that's what you actually need to do. Anyone has any questions pertaining to it, or else we can actually move forward? Namita, the Word file is added to the Word file is actually added to this handout section. Okay, understand the relevance and reliability part is basically that if this Rothko University is publishing its information using these, in fact, if it's publishing all these information, what are those information? Those information are like if the Rothko University is publishing its graduation rate, its academic performance. So how is it relevant to somebody who wants to know about the performance of Rothko? So that's what he's asking, that how is it relevant to somebody who is evaluating the performance of Rothko? And the Word file, the updated Word file would actually be sent across over the email to you people tonight. You will get the updated file. Now the next question that you have to do is you have to go to December 2014 and December 2014 question number 3 part B. Yes, not the shareholders. Uh, in fact, it's actually going to be whomsoever, because generally it's not the shareholders relevant over here. This report of university's performance is actually for the prospective students, those who want to take admission, so that they can decide if they want to take admission or not. Because if I want to take an admission into any qualification, I would want to see that are the existing students satisfied, are the existing students getting employed or not, etc. So take 5 minutes till 8:20 p.m. and try to go through this December 2013 question number 3 part B. The Saturday timings are 2 to 4. Okay, now let's talk about this question. So if I say, it says discuss the difficulties in measuring and reporting on social and environmental performance and recommend the procedures to be used to gain assurance on the validity of the performance information in FasterJet company's CSR report. Now see, if I talk about it, it says your firm has been engaged to perform separate assurance engagement on FasterJet company's corporate social responsibility report. This engagement will be performed by Brown and Company, the specialist social and environmental assurance department, and there are no ethical threats created by the provision of this service in addition to the audit. An extract from the draft CSR report is shown below. So now what does it say? It says your firm has also been engaged to perform separate assurance engagement on so and so, so and so. So what are they doing? They're publishing a CSR report. That's what we need to report on. Now it says the CSR objectives, the CSR target. So there is this CSR objective, there's this CSR target, and there's this performance of against the CSR in 2014. That's what is there. Now if I talk about it, number one thing is the number one thing is basically it says that the objective of the CSR is to continue to invest in local communities and contribute to charitable causes, and the CSR targets are so and so, so and so. Now what do we need to do? We need to do this way, that the CSR, the requirement is discuss the difficulties. It says discuss the difficulties in measuring and reporting on social and environmental performance. Now it's a 4-mark question, meaning that the examiner wants you to give 4 points. So difficulties in measuring social and environmental performance. Difficulties in measuring social and environmental performance. Now, if I talk about it, that what are the difficulties that come across when we talk about the measuring of the social and the environmental performance. Number one of them is what to measure. The second one of them is how to measure. The third one of them is lack of scale available. So these are the various things. I mean, there is this, you don't know that what to measure, you don't know how to measure. So these are the various issues that actually arise. Second thing is that at times it's quite subjective. So a judgmental thing or a subjective thing, that's also an important area. Now the next step is basically you need to talk about recommend the procedures to be used to gain the assurance on the validity of the performance information in FasterJet company's CSR report. Now if I say that what are the procedures that are to be used to gain assurance on the validity of performance information, so let's just talk about them one by one. Now if I say number one of them is the target was to make direct charitable cash donations to local charities. So what was the target? The target was to make direct charitable cash donations to local charities. That was one of the target. Now, what is the performance in 2014? The performance in 2014 is that donations of 550,000 were made to local charities. Donations of 550,000 were made to local charities. Now see, so I need to actually, my procedures should always be like, you need to think what could go wrong. Your procedures should always be like what could go wrong. Now, if I talk about it, number one thing is that I need to actually inspect the cash receipts of donation. I need to inspect the cash receipts of the donation. Secondly, it says build relationship with global charities and offer free flights. It says 800 free flights with a value and 560,000 were provided. So confirmed from global charities about the grant of free flights. Furthermore, ascertain if the management has used a reasonable basis for the valuation of free flights. Next thing is it says develop a local learning initiative. So there was 750,000 was spent on the local learning initiative and 2250 children attended the education days. So you could inspect the attendance sheet to confirm 2200 students attended it. Then in addition to this, inspect vouchers for expenditures to confirm that $750,000 has been obtained. Furthermore, if I say that it says reduce the amount of vehicle fuel, so the KPI is basically the number of miles. So what we need to think is if the number of miles that have been traveled in the vehicles, has it been reduced because of the management's intention of not traveling, or has this been reduced because of the reduction in meeting? So what we can do is that compare the meetings held in last year to the meetings held in current period to confirm if the reduction in miles traveled was because of the use of digital modes. So I think you get how we need to actually go about with this such a question where the environmental and social performance is being judged. So the basic idea about everything is you need to think what could go wrong. Basic idea about everything is you need to think what could go wrong, and then you could actually go about it. Okay, so now the next topic that I'm going to talk about is the ISAE 3400, which is examination of prospective financial information. So if I talk about this ISAE 3400, which is the examination of prospective financial information, so let's just discuss that. What is this ISAE 3400? So if I talk about this prospective financial information is basically the future financial statements. The future financial statements. Prospective financial statements are actually the future financial statements. Now, so whenever we talk about these prospective financial statements, it's actually the prospective financial statements are future financial statements. Now, if we see that the prospective financial statement could actually be forecast, they could actually be projections. Prospective financial statements could actually be forecast, they could actually be projections. Now, what's a forecast and what's a projection? The forecast is basically when reliable estimates are used, that's called forecast. Meaning you already have a history. And growth is ascertained based on such historical data. And the projection is basically, it's based on hypothetical assumption. It's based on hypothetical assumptions. The projections are actually based on hypothetical assumptions. So when does this prospective financial information comes in between? The prospective financial information comes in between when basically what happens is that when we talk about these prospective financial information, they come in between when you apply to bank for a loan. When you apply to bank for a loan, at the same time you need, at times you are in the process of issuing a prospectus. When you apply to the bank for a loan, or you're in the process of issuing a prospectus, or maybe the company wants to correspond with the shareholders. So usually you prepare this prospective finance information, and these prospective finance information are then presented to an audit firm which gives you an assurance report on these prospective finance information. So when we talk about PFI, so these are the reports that are actually handed over to an audit firm to give a report on them that these forecasts or these projections have actually been correctly prepared. Now, when we talk about hypothetical assumption are without any base. For example, let's take this example. I am somebody who operate in education sector. If I have an expansion plan and I go to a bank for a loan, I'm repeating it again, I'm somebody who operates in the education sector. What happens is that I go to a bank for a loan because I want to expand. Now the bank would ask me for the forecast financials, and I would be able to give them forecast because I have a history of running an educational institution. I can give them a forecast for an education sector because I know how the education sector operates. But if I go to a bank for a loan of setting up a chemical factory, then it's all going to be hypothetical because we don't have a historical data, we don't have a historical performance. So it's just going to be something that would be based on hypothetical assumptions. Anyways, let's come on to the question, which is December 2016, question number 3. December 2016, question number 3. This is actually on PFI, the prospective financial information. So December 2016, question number 3, prospective finance information. It says evaluate the appropriateness of the cash flow forecast and recommend further audit procedures, comment on matters to be considered in respect of the loan by Mr. J. Stewart, and recommend the further audit procedures to perform. Kindly go through it in 10 minutes and then we'll discuss. No, Abdul Basir, the mock is going to be on Saturday. There's going to be a mock debrief only. Okay, guys, I would need a favor that the team, they actually need a feedback of overall about how the session went, and also it would actually help me improve the session also in case if there is anything that you want to suggest or anything that you want to actually comment on about the session, so we could actually take your suggestions and we could improve. So please go ahead and give your comments. Anyways, let's talk about this question, which is, you are the manager responsible for the audit of Rob company for the year ended 30th September 2016. During a visit to a team performing the field work, the audit senior shows you a cash flow forecast covering 6 months period to 30th September 2018 as prepared by management as part of their assessment of the going concern status of the company. The audit senior asks whether any of the forecast cash flows disclosed require any further investigation during the audit fieldwork, etc. Now, the actual and forecast 6 monthly cash flows for Rope Company for the periods ended. The actual, which is 31st March 2016, 30th September 2016. The forecast is 31st March 2017, 30th September 2017, etc., etc. Now, so we've got this actual and the forecast. So the actual is basically at March 2016, 30th September 2016. The forecast was our 31st March 2017, 30th September 2017, 31st March 2018, 30th September 2018. So there are these receipts from customers, payment to suppliers, salaries, other operating cash payments, etc., etc. Then there are these other cash flows, sale of investment, repayment of J. Stewart loan, etc. Now, the following additional information has been provided in support of the forecast. Receipts from customers and payments to suppliers have been estimated based on detailed source forecasts. Salaries and overheads have been estimated as the prior year cost plus general inflation of 2%. Bank loan expires on so and so. Now, it says evaluate the appropriateness of the cash flows forecast prepared by Rope Company and recommend the further audit procedure which should be performed. Now, what my suggestion to you people is going to be that you have got the numbers, you need to evaluate the appropriateness. Now, what do you mean by appropriateness? Appropriateness is it in line with the comments that are mentioned here? Is it in line with these additional information which mentioned here? Second point is that are they reliable? I mean, if we actually have the trend, we have the 31st March 2016, we have 30th September 2016. So we've got last 1 year historical data. So are these forecasts in line with the historical data or not? So that's also an important area. So that's what we need to actually talk about. So so if I do actually go about it, I would say that that this is what you need to do. You need to have this 31st March 2016, 30th September 2016, etc., etc. You need to calculate the ratios and you need to compare the growth rates with the forecast that's there. Furthermore, you need to compare them. So what I would actually suggest you people to do is basically you try and attempt this question on your own. You calculate growth rates. You test the numbers against the notes given, so you will have a better idea as to are these numbers correct or not. So for what I would actually suggest you people to do is that you should actually perform this testing, that if these things are correct or not. So basically you need to evaluate appropriateness of cash flow and recommend further audit procedures. So it's a 14 mark thing. So you could actually say that 4 to 5 marks are for the procedures, but major area is going to be evaluation. The major area is going to be the evaluation. 4 to 5 marks are going to be for the this thing, and 8 to 9 marks or 9 to 10 marks are gonna be for the evaluation. Anyways, so you try doing it on your own, and then we would try and actually go through we would try and go through this specific question tomorrow so that we could have a better idea. Thank you, Sania. Thank you, Janet, and thank you, Abrar, for your feedbacks. We would actually try and cover up in a better manner, inshallah, tomorrow also. And I would want you people to attempt this question, because you try and actually perform the analytical on your own so that we could have a discussion on this question tomorrow. So I'll keep it till here today, and let's start off tomorrow. So tomorrow's the topics is going to be, we have left due diligence, and we have got section A, B, C of the syllabus, which is quality control and the ethics and the professional issues. So these are the things that we are going to go through tomorrow, inshallah. So let's start off tomorrow. I'll keep it till here. See you all tomorrow. Yes, the handout is going to be shared. This is going to be sent across to you by email.